You're listening to AM Now, an Accounting Matters podcast. I'm Adam Olsen.
And I'm Nicole Harger.
We're kicking things off with an update on the legal proceedings surrounding the SEC's climate-related disclosure rules. In the days and weeks following the SEC's adoption of the rules on March 6th, 9 separate lawsuits challenging the rules have been filed in 6 different U.S. Circuit Courts of Appeal. Given the multi-district litigation, the United States Judicial Panel convened and randomly selected the 8th Circuit as the venue to consolidate those lawsuits. The 8th Circuit designated a case brought by the state of Iowa as the lead case. Shortly thereafter this appointment, the 5th Circuit dissolved its previous administrative stay of the rules and transferred the litigation to the 8th Circuit. Plaintiffs have now requested the 8th Circuit to issue a new administrative stay. To date, though, no judge has been assigned to the case.
Fast forward, given the litigation activity, the SEC preemptively issued an order staying its climate-related disclosure rule until the litigation is resolved. The SEC has vowed to continue vigorously defending the final rule's validity in court. As part of issuing its stay of the rules, the SEC noted they wanted to avoid regulatory uncertainty if registrants were to become subject to the final rule's requirements during the pendency of the challenges to their validity. The SEC has also indicated that its previous 2010 climate change-related disclosure guidance, which has been cited in the SEC comment letters and enforcement actions scrutinizing climate-related disclosures, remains effective and will be a focus of the enforcement. We will continue to monitor developments here as they develop.
Yeah, it'll be interesting to see how that all shakes out. And I know a lot of companies are still planning to move forward with preparing even despite the stay. So see what happens there.
More to come.
Yeah. So switching gears to the FASB side of things, we have the first 2 accounting standards updates of 2024 that have been recently issued. The first update, ASU 2024-01, addresses feedback from stakeholders regarding the complexity and diversity in practice in the accounting for profits, interest awards, and other similar awards granted as compensation, particularly whether these awards should be accounted for as share-based payment arrangements in the scope of Topic 718, or other applicable gaps, such as cash bonus or profit-sharing arrangements in the scope of Topic 710. Though not a defined term in GAAP, a profit interest is an interest in a partnership or other pass-through entity that would receive no proceeds if the entity were to immediately liquidate at the time of the receipt of the interest. Profits interests are contrasted with capital interests in that they only allow holders to participate in the future profits and or equity appreciation of the issuing entity and do not provide those holders with any rights to the existing net assets.
To address the scope application issue, the FASB issued 4 illustrative examples to Topic 718 and amended current guidance in the scope section to improve overall clarity and operability. The illustrative examples are intended to highlight common fact patterns and emphasize the relevant facts to be evaluated. Although profits interest awards are most prevalent among private companies, the update is applicable to all reporting entities. Public business entities must adopt the update in fiscal year 2025, and all other entities must adopt in fiscal year 2026. The update may be applied either retrospectively or prospectively, and early adoption is permitted.
Yeah, and the second update, ASU 2024-02 from the FASB, contains amendments to the codification to remove references to the FASB concept statements, which are non-authoritative concepts established by the FASB's conceptual framework that help guide the board when they're developing accounting standards. Removing these references simplifies the codification and draws a distinction between the authoritative and non-authoritative literature. The amendments in the update are not expected to have a significant effect on current accounting practice or cost to most entities. The ASU is effective for public business entities in fiscal years 2025 and all other entities in fiscal year 2026. Again, early adoption and application is permitted. The amendment should be applied using either a prospective or retrospective transition approach.
So continuing on with our FASB updates, the board recently convened and made several tentative decisions on its ongoing project aimed at improving the accounting for internal use software costs. The first tentative decision specifies that projects with unresolved high-risk development costs should be accounted for as research and development costs under ASC 730. Second, the proposed changes are likely to adjust the criteria for which costs can be capitalized during the software development phase. Traditionally, costs incurred during the preliminary project and post-implementation stages are expensed as incurred, while capitalization is permitted for costs during the application development stage. The changes could redefine these stages or provide clearer guidance on what constitutes development activities that qualify for capitalization.
Yeah, the board also discussed and decided against pursuing a single reporting model to align accounting for external and internal use software. So ASC 985, which is cost of software to be sold, leased, or marketed, will therefore not be impacted. And just as a reminder, as with all decisions made in these meetings, they are tentative and may be subject to change in the future meetings until a final ASU is issued by the board.
Yep. And so in a subsequent FASB meeting, the board also made several tentative decisions regarding the proposal over disclosures of the disaggregation of income statement expenses. As a reminder, the FASB has been exploring ways to require companies to break down their income statement expenses into more detailed categories. The goal is to provide stakeholders, including investors and analysts, with better insight into the components of a company's operating costs and expenses.
Yeah, and in this meeting, the FASB made several tentative decisions related to the project, which, if implemented, would significantly impact financial reporting practices for most companies. For example, companies may need to revise their accounting systems and processes to track and report expenses in the required level of detail. This would also impact existing internal controls and processes to ensure the accuracy and completeness of the disaggregated expense information.
During the same meeting, the board also made tentative decisions that pertains to accounting for environmental credit programs, another key project on the FASB's technical agenda. If implemented, companies would be able to elect to remeasure eligible assets to fair value with changes affecting earnings. Additionally, guidelines for recognizing and measuring environmental credits and business combinations were clarified, ensuring consistency and transparency. The board also addressed purchase commitments and non-refundable deposits, emphasizing financial reporting integrity and environmental considerations in corporate decision-making.
And pivoting back to the SEC for our final update, the Commission is implementing various technical amendments to several rules and forms under the Securities Exchange Act of 1934 and the Investment Company Act of 1940, in response to a federal court's decision to vacate rule amendments made on May 3, 2023. These initial amendments were aimed to modernize and enhance disclosure regarding the repurchases of an issuer's equity securities registered under the Exchange Act, with the courts vacating the repurchase rule effective as of December 19, 2023. Regulations have reverted to their pre-existing state effective April 8th of 2024. If that wasn't confusing enough. But that rounds us out for this week. For a deeper dive into what's trending in accounting, finance, and sustainability reporting, check out our other podcast on the Accounting Matters feed on your preferred listening platform.
Also, we'd like to give a shout out to another Embark resource, our guide on ESG reporting best practices, implementation, and beyond, which is available in the show notes to this episode.
Good reading there. So again, I'm Adam Olsen.
And I'm Nicole Harger.
From your friends at Embark. Thanks for listening to AM Now. Stay happy, and we'll see you next week.